All right, Srikanth. You own Netflix with a significant gain. Stock gap down on earnings yesterday. What strategy would you recommend given the current technicals? First things first. Yes, the stock pulled down. It pulled down again today. How far have we dropped since earnings a few days ago? 40 to 50 points. Let's call it 50. Oh, it says last is 315.10. Well, you were at 380, so we could even say that was 65 points. Okay. What do they call it on South Park? They had a superhero episode where the kids were all dressed up as characters. They ended up calling Cthulhu out with the DP oil company. Captain Hindsight. Okay, I don't want to be Captain Hindsight here, but I am going to be. If you're just trading a stock long term, whether you're trading it as a covered call, even if you're using it as standard collar, my advice to you at any time is, especially if you have a gain in it, what you want to do before the earnings is go to Married Put tab, go to Insurance, put in your cost basis, NFLX, and let's say you had bought the stock, you had a cost basis of 265.70 when the stock was trading at 380 or 360 even. And as you're going to earnings, just run this. So what does this tool do? It shows me that if this was your price, even now after the climb, but if your average price around 265, stock's at 49.40. Before earnings, what I would have done is potentially bought one of these put options to have the locked-in profit going through earnings. I don't want to take the chance of the unexpected. If I've got even if I've got only a 20 to 30 point gain in the position, this is about 50 here, right? Yeah, we're about 50 point gain. But on this one, even if it was only 20 or 30, right before earnings, I still would have used this tool and found something to at least hedge that hedge that gain, even for the unexpected. Because you know what? If I paid $9.83 for this put, and even though I've got an 18% locked-in profit, what does this do? This guarantees me 15.2%. Okay, so let's take a look at the profit and loss chart. Had a cost basis of 265.70, I'm sorry. And I buy a 317 put at the time, let's say it was trading around 315, for $9.82. The stock falls. What have I done? I've guaranteed a profit of 15.2%. The stock moves up. Yes, I'm giving up maybe some of this $9, but I've left the upside open and still guaranteed, what's that, 85% of my unrealized profit at this point. And if you still have a gain right now, and you're planning on holding Netflix long term, hoping for a turnaround in the next 3 months, I would do this, put in your cost basis, put in Netflix, put in your cost basis, and I'd go to an expiration. Oh, I'm sorry here. This shows me all expirations, but what I might do is scroll down, and I'm going to go out to December. It's at least 150 days away. That'll cross at least two more earnings, maybe 3. Let's see, July. I'm sorry, no, just the 1. My apologies. Yeah, it'll just cross the 1. Thought it was 2, it'll just cross the 1. Okay, so here it's not too great. That's okay, because there's probably a lot of volatility in this right now, but 315, it's about half. Okay, so even if this was only a gain of 18.6, for the next 154 days, I could buy roughly an at-the-money, slightly in-the-money put, gives us the best protection, but I could guarantee half of this unrealized return I'm still standing on. And what? When the stock at 315, holding a 325 put, well, now that the stock is trading there, I have locked in my gain, at least some gain I'm still standing on for the next 154 days. But depending on my expectations, hey, I can generate some things back here. I can maybe get a little $3 added to this of the 8 I just spent. Oh, I'm sorry, the 31 I just spent. My apologies. But near term, hey, I've got a standard collar. I've increased that downside protection. I might still need to manage it if it moves back up quickly. But you see what I'm doing here. I've locked in profit. Hopefully you still have a profit on the position. You said now that it's turned down. But even if the stock continues down, what have I done here? I've guaranteed some profit originally. Then I added to that guaranteed profit by generating a little bit of premium, even if I think the stock's still falling down. what haven't I even done yet? I haven't even really looked at the stock. I mean, we pulled it up to see the decline, but I haven't looked at the technicals yet at all. Why? Because your question, Srikanth, impresses to me that you are in the stock position. You didn't hedge it going through earnings. I don't want to be Captain Hindsight again. But now you're in a situation where you might still be having a gain, and what do you do? Well, what you're kind of saying is that you haven't sold to close the stock yet. I can't give you direct trading advice as far as that goes, but you haven't sold the stock yet. So you're holding on to it, hoping to get back to the, I hate to use this term, but get back to the promised land you saw 5 to 6 days ago, because you don't want to give up on the idea that this could actually become a loss because you had such a big gain to begin with and it just didn't come to fruition. Okay, maybe someone commented, was that Jim? Yeah, Jim commented in and said, oh, well, aside from buying the put ahead of earnings, you could have just sold half of it and locked in that profit and maybe had no risk on the stock shares, or you could have sold 3/4 of it. Okay, that's also valid, but that's, again, don't want to be Captain Hindsight. Technically, this thing still looks like it's declining. And remember, the market pulled back at the end of the day today a little bit too, and the volatility increased. I don't know if that points to a down market on Monday, but are we going to expecting it to go down drastically? I can't tell you. I don't know. This might go as low as 290. This might go as low as 275 before it comes up. I have no way of knowing. But based on the concept that you're asking me this question and you haven't closed the stock out yet, and you mentioned that you had a really decent, significant, I think was your term, gain on it, that impresses that you might still have a gain on Netflix at this point. You have yet to close the stock yet, so I'd consider locking in the profit now, and even if it continues to fall, you've got some guaranteed profit, and just because you're in a married put position now, a protected, what we call bulletproof married put position, if this is your scenario, you can still trade shorter term adjustments, what we call income methods, against it. Now, this is what I do with 50% of my portfolio, but starting from the start. We use the married put position where I'm buying a slightly in the money put at least 150 or 180 days out in time. And I'm only carrying a maximum risk in the absolute worst case scenario at expiration, 6 months, 7 months down the road, if the stock's still between the put strike price of 5 or 6%. But if you're holding stock positions long term, and you're going to be holding them through earnings, use that insurance tool. Evaluate a cheap put to lock in most of your unrealized gain. And as we saw, well, if the stock falls, in our first example, we saw the closer ones, the August ones and everything, you still would have locked in 15% or so of the 18% unrealized gain we had. It was 18.6 to 15.2. That was guaranteed if the stock fell 30%. The prices might have been different around earnings because the volatility would have been higher, but you still would have had some of the unrealized locked-in gain, most of it, 60, 70, 80% of it, by just looking 1 or 2 weeks out, maybe, probably 1 or 2 weeks past expiration, maybe 20 days past expiration, and lock that in. We didn't do that, so now we're in a situation here. You haven't closed the stock yet. You're still holding it. If you still have a gain, even if it's small, even if it's only 8% or 9%, you haven't closed it yet. So that impresses upon me that you're trying to hold this position and try to get back to break even or get back to where you were, not even break even, I'm sorry, but get back to where you were at that 380 mark for the profit that you saw 10 days ago. But if you're wrong, why risk the other 7, 8, 9% unrealized gain you have in that position? Lock it in with the put now. And, oh, good grief, I'm sorry. Now it all makes sense, and I should have thought of this, Srikanth. You're absolutely right. Someone who's better at finance, not saying bad at finance, but someone who's better at finance probably would have picked this up right away. Srikanth says, good insight, thanks. My basis is around 106. Whoa, fantastic. Still, I know it hurts. I know it hurts seeing that 65, 70 point drop, but yeah, that's fantastic. Of course you didn't sell. Why didn't you sell? Because you wanted to avoid the tax consequences of still having over a 100% gain on this position. Got it. So if you're planning on holding it longer term, even through the next year, you could go out to January if you wanted to. I'm just going to go back to December again. Stock is around 315. You've got an unrealized 197% profit. Going out to the December puts again, you're looking at the 305, 300, 315 even. You're only locking in. I'm sorry, this just sounds funny to me. This is fantastic. You're only locking in about 140% of the 197% unrealized profit you had. But that's for almost 6 months. You've got a bulletproof position, guaranteed profit, and even if it falls down to 297, what do you have? A put that's out 5 months, and you can still sell premium against it. We look 14, 20 days out. We can even go 14 days out in time. That's almost $3, right? Yeah, go out to the 325, give you a little bit more room. It's really hard to do in these cases because it could snap back very, very quickly. But now what are we doing? We're getting it back up there, 145.7, and a peak here at 178 that you'd manage, but you're generating income to help pay for that put you purchased to lock in 138.9% return. Okay? Because you're holding it to avoid tax consequences. Hey, it could continue to drop. It could move back up. You don't even need to sell anything on it. You could just buy that put. You've got 5 months of guaranteed profit. You're guaranteeing 148% of your 197% unrealized profit. No tax consequences. I'm kind of okay with that. And if it falls, you can manipulate the put at any time. What happens if it goes down to 260? Well, this put you just paid $19.55 for is probably going to go up to $60. It's going to be at least worth $40 of intrinsic. Another $20. You could just sell to close that, take the gain on the put. What is that going to do? Lower your cost basis on the position further, right? I think that's your plan. And of course, this is after the fact, bulletproofing after the fact if you've got a locked-in gain. I do have a webinar somewhere. It's called the hat trick for locking in gains. I don't know if it's here. I know it's on YouTube. If you go to YouTube and look up the hat trick for locking in gains, you'll come across a webinar I did that discusses that tool, how and when to use it, what to look for with selling the call and more. Okay, that's what you could look at there. Oh, that's not Paul. I'm sorry. That's James. James makes a comment too. Says he could just build a standard collar month by month. That's true, and you can look at that. What they're referring to there, whoops, oh, I went the wrong place. I'm sorry. What they're referring to there is that for a cheaper cost, rather than going out to December, doing a standard collar, let's say for standard August expiration or September expiration, let's go to August, but that'll show me all the weeklies, it's okay, is this tool will also actually to buy a put and sell a call. It'll calculate that for you. So if you do a sort of a standard collar here, these are conversions, 317, you don't want that. You want more something along the lines of a 310 put. Yeah, they're not really showing up as well as they should. But more or less doing like a maybe not even that high, a 305 put with a 320 call just for August. And that would put you in a capped gain similar to what we just saw, but also a guaranteed profit. So what did I mention? I mentioned the 305 probably, and then the 325. Oh, that's the buy put, sell call. 10 by 10, 10 points up, 10 points down roughly. Yeah, so 189 locked in profit with potential for a 207 gain because you're paying less. But over the next 5 or 6 months, you'd be buying this put at 568 and sort of selling a call at 613. But if you had to roll the call, that would be adding to it. But remember, the 305 is out of the money. It has to drop the 305 before that insurance kicks in. And if I did that for 6 months in a row, that's still about $30, right, out to December. Same cost it is right now, just buy the December 325 that's slightly in the money, and you're guaranteed to get $10 of that 30 back, so it's really costing you 20. So it's just cost. But yes, you're hedging that by the call premium, getting about $1. Actually, that's only about 50 cents premium. That didn't lower your cost basis by much, but it still puts you in a nice situation if you're not expecting the stock to recover quickly, which could be a concern. So I'd be more apt to do that longer-term married put first, lock in most of the unrealized gain that you have right now, at least 3/4 of it look like. And if it rockets back up, you can still adjust that put, by the way. It's not going to go to zero. That put I bought in December at 325, even if Netflix comes back next week and is at 340, that put still has 5 months of time value on it, 4 months and 3 weeks of time value on it. It's still going to be priced around $22, $23. Sell to close that, yes, you took a loss, but you could move the put up and do something else. What I'm talking about, of course, here is the adjustments we use on the protected positions that's discussed in the blueprint, where the 12 different income methods help us lower this risk to where we're in a bulletproof position. Right now, you can get it what's called bulletproof in the beginning and then do the income methods off of this structure to keep increasing that bulletproof status, although sometimes you might have a capped gain. But you're increasing the return, the guaranteed return here on the position without facing the tax consequences. That's the blueprint there, and check that out right under the Power Options store or at radioactivetrading.com, and that's the technique I use with 50% of my personal trade, 50% of the money I have allocated to options trading. All right. Martin said, is there a video about buying straddles during earnings and which strikes may have more probability of success? Martin, all of earnings testing, there's a couple of videos there. If you go to Long Straddle or Long Strangle, I'm sure you've already seen this. Ernie's got his Introduction to Straddles video here. Okay. Which strikes, I'm almost positive on this, that the best strikes to use long-term if you're planning on doing this in your portfolio with any portion of it and just consistently look for every week 3 to 4 stocks to buy a straddle on that has earnings coming up, the best strikes are going to be right at the money. It's as simple as that. It really is. You can't say that, oh, well, this one has a leading indicator where it's been up 5 days before the earnings announcement, and so that's an indicator that's going to drop. So I should skew my straddle where if the stock price is here, I should buy a put that's further out of the money for lower costs and a call that's deeper in, or buy the put that's deeper in the money and a call that's further out to get the maximum profit if the stock falls. Well, that idea of the stock moving up 4 or 5 days before earnings leads to a stock decline is only right about 50% of the time. The idea of a stock being down 3 to 4 days before earnings always results in the stock moving up is also only correct about 50% of the time. So you're skewing your direction here to try to catch the right movements and the wrong movements. And everything I've tested personally when I was trying to help Ernie with this, looking at things such as put-call ratio, put-call open interest ratio, changes in MACD prior to the earnings, changes in MACD 10 days before the earnings, changes in MACD 5 days before the earnings, there was nothing. There was a consistent indicator that if X, then Y, and the stock moved up at earnings. It's hit or miss. It really is. This is more of a random strategy, honestly. Ernie's doing all his testing and is going to have some of that information for you on his approach and everything that he does with this. But to tell you the truth, it's a lottery ticket because it's based on the unknown. Netflix, for example, we could see all of the trends doing exactly what we want, and you can say, oh, I saw Netflix falling because it had 4 or 5 profitable quarters. It had 6 quarters of increased subscription. It had to fall at some time. Well, look at you. You picked it right. Meanwhile, 3 cycles ago, people were saying that, oh, well, Netflix has to fall on this earnings because they've had 4 quarters in a row of increased subscription and increased profits. That can't last. This has to be their drop. It wasn't. Kept going until it dropped. All right, so it's the unexpected. This to me is really a lottery ticket. Should only represent maybe 5 or 10% of your total portfolio value. Okay. Okay, this is a personal question. And I'm hitting my goals here. I got to say this first. I'm hitting my goals, but I am no way the best trader that you've ever come across. There are traders out there who are making much more money than much bigger returns over the course of the year. But Martin just comments, says, you're so well versed in all these probabilities. How long did it take you to become so comfortable with the data? I started working with power options around 2001. And at that time, I had known Greg, the CFO, of course, COO, CFO, Ernie's son, since high school. In any case, they needed someone to help. The company had grown so much. They had so many customers from different groups out in Texas. You probably know a few of them who were sending their clients to power options, and they needed help with the phone. So I started answering the phones and then started learning as Ernie would teach me. started with covered calls, applied to trade covered calls with a small amount of money I had at the time, got approved at Options Express, so on and so forth. I didn't start being comfortable handling coaching sessions at that time, and keep in mind it's still 15, 16 years ago. Power options was a little bit different then. It's gone through many changes. But I didn't start actually handling coaching sessions till about 4.5, 5 months in. I was reading everything I could. I was learning from Ernie. I have this weird advantage. I'm gonna talk about it in sort of the product lines that we're coming out with for the different strategies, Martin. But I had this weird advantage where I knew stocks basically, didn't have a finance background. I knew what stocks did. I knew how you could buy stocks. I knew to buy low and sell high and all that stuff. My 5 or 6 months deep education into options investing was just on options. I did something a little bit different than most of you did. And I think it's beneficial, but at the same time, there's pros and cons to it. I learned the ins and outs of each of the strategies first without even considering the underlying stock or what stock to look for. I just considered that in this strategy, I need a stock to move up. I want to look for these deltas, these probabilities. That makes sense. I want to have a better success rate. You read things like Van Tharp, and then you read things about the 20% rule and rules of probability, and it starts to click. You say, yes, if I'm taking a 10-to-1 risk-reward ratio, I need to be right 91% of the time. If I'm taking an 8-to-1 risk-reward ratio, I still need to be right 82% of the time. The math just works. Okay, you've seen me run examples on the bull put spreads, Martin, I believe, where I showed that historically, if I'm looking for positions with a 75% probability, I actually need 77% to be profitable long term. At 75%, it's just at break even. And at 72%, I'm sorry, if I look for 70% probability, I'm not profitable even at 71 or 72% success rate. 73% breaks even, 74 is profitable long term over, let's say, 100, 150 trades. That's the nature of the spread trades. So that's why I'm looking for that 85% probability, because believe it or not, when you go to that range and you're still keeping an 8-to-1 risk-reward ratio, being right 83% of the time below your target is profitable. 82% is sort of break even. It's kind of strange, but that's how the math works. In any case, that was my education. That's when I started to get comfortable. And of course, I started delving deeply into the calendar spreads before anything. I was trading collars and calendar spreads in my first few years before I even got into trading vertical spreads. I was scared of vertical spreads for a while. I was just learning as I was going. There's some strategies I've never traded. You've probably picked up on that. I've never traded an iron butterfly, an all call butterfly, or an all put butterfly. Okay, I have traded them. One, saw how it worked, didn't like the idea of constant management of it, abandoned it, didn't like it. I've never done a ratio back spread in my portfolio. Not that it's not a good strategy, I just don't have the time to manage it. I've never done delta neutral because it's too time consuming. Okay, but I learn each of the strategies over that first year as far as the, what's the term I'm looking, the fundamentals, the general rules without even considering the stock, and then going back and saying, now, what are the best indicators for a stock that does X, Y, or Z that I want? Relying a lot on what Ernie had already done over his years of testing and in the search criteria to help with that, and then made adjustments as I saw fit. So that's a side story of me. Martin's further comment is, platforms have various strengths and weaknesses. For options, which platforms do you feel are the most useful to aid us in success with the probabilities? They're all pretty good, but they're all subtly different, and this is a problem that comes up consistently. The probability equation, just like the Black-Scholes pricing model, takes into account similar aspects, as does delta. Okay, and what do I mean by that? The Black-Scholes pricing model takes a look at sort of the common 5 factors: the underlying stock price, strike price of your option, days remaining to expiration, free interest rates on the market, and the volatility. What's wrong with that equation? Why doesn't everyone have the exact same Black-Scholes theoretical price for all the options on the exchanges? Is because there is no one rule of thumb as to which volatility to use. We all choose which one we feel is the best. Someone's going to use a 20-day volatility. Someone's going to use a 30-day. Someone's going to use a 1 year. Someone's going to use a 100-day volatility. Someone's going to use a 90. Someone's going to use the stock's implied volatility index. Okay, that's why you see subtle differences. Deltas doesn't take into account all of those things, but it does take into account similar things based on looking, well, what volatility you're kind of using for delta, or what time frame are you looking at for that analysis? Are you looking 10 days, 20 days, 30 days, 50 days, 60 days, 45 days, 90 days? The numbers get out there. So everyone's using what they feel is the best numbers. Not that anyone is calculating it incorrectly. There is just not one known standard. So where am I going with that? Well, it might be any platform that you feel, if this is the kind of analysis you want to do, you want to get deep into the probabilities, Martin, you want to get deep into the Greeks, you want to do that kind of analysis, I'd look for a platform that shows, we do, of course, for the options, you can see some of the different volatility numbers, but look for a platform that shows you the probabilities of the numbers based on a 20, 50, or 30, 60, 100, and maybe 200-day movement. What do I mean by that? Someone just commented, what do you mean by that? Okay. I'm just taking Starbucks for an example. I want to go, I'm just going out to next week. I'm just going to take a look at the call research page. So here, okay, so here, yeah, we're showing you the Black-Scholes numbers. And what's also another theoretical price, what's known as the Barone ratio, the Barone value, and the Cox-Ross equation. They're all pretty much the same, but we're showing it to you based on 20, 50, 100, and 250. So we just show the standard probability above and below, not based on that, but if you want to delve into that more, Martin, you'd look for a company that offers that. Anyone has any that they know that show different probabilities based on different time frames, let me know. I thought Thinkorswim did. Not sure if they still do after the Ameritrade movement. I think Interactive Brokers does. I bet you Tastyworks probably does as well, where they show different sort of probabilities, the probability of touching, but also probability based on 5, 10, and maybe 20-day. I'm not positive that they do. I thought they did. So that's something you might want to look for. If this is how you're going to trade, if you're going to be delving into probabilities, the different types of Black-Scholes numbers, theoretical values, theoretical movements, I would look for a broker that offers you multiple numbers so that you can gauge that based on the movement of the last 20 days, what might I expect, and then 50 days, and then 100 days, what might I expect as well. That's what I'd look for. Check out those three first. And if I think of any others, Martin, I'll let you know. Oh, wow, it's not letting me scroll up. I can't even read the name. Final question come in. David says, do you have a radioactive portfolio that people can follow and mimic? Yes, we do. The radioactive trades, mine, I'm sorry, David, one second, there we go. My trades, Ernie's trades, Kurt's old trades, even Greg's current married put positions following the rules in the blueprint is at RadioActiveTrading.com. It is called the Fusion subscription. Okay, so as a blueprint owner, you might be able to get your first month of Fusion for only $10 if you're a recent owner of the blueprint, a recent purchaser of the blueprint. Okay, and yeah, so RadioActiveTrading.com, the Fusion subscription here, there's a variety of lessons Kurt, myself, and Ernie have put together for you. It's sort of set out in drip content to help you get more familiar with the materials and increase your learning curve. The RPM report here, same as the search and power options. If I'm not opening a new trade this week or haven't in a couple weeks, I'm managing my other positions, you want to open a new trade, you just go to the RPM report or the Married Put search and power options. Those are the same trades Ernie and I would pick from if we were selecting a trade today. A stock insurance tool is here too that we just looked at, and members-only webinars and white papers, both for Blueprint owners and for Fusion subscribers. But the Open Trades Trade Tracker, this shows you Ernie's current positions, my current positions, and Greg's current positions as well. So you follow them, you get the updates here. You see Ernie made an adjustment yesterday, is bulletproof on this position. Anytime an adjustment is made on the position, rolling the put, rolling the call, doing any of the 12 income methods, it's shown here for you in Fusion, and any Fusion subscriber will receive an email with the details as soon as we place that trade. But that subscription's at RadioActiveTrading.com. It's not on Power Options, David. It's at RadioActiveTrading.com, and that's the Fusion subscription. In addition to that, you can also check out the track record historically for Ernie, myself, Greg, and of course Kurt as well. So that's what's available on Fusion, David. So go to radioactivetrading.com and check out the Fusion subscription there. Use your login that you were given that you might be using on Power Options. If you log on to radioactivetrading.com as a Blueprint owner right now without even subscribing, you can access all of the Blueprint owners information there, the white papers that you saw and the members-only webinars. Just go to radioactivetrading.com. You don't have to be subscribed to Fusion yet. You can check out that information. But the reason I say to log in with that password that you have is because that'll register you, recognize you as a Blueprint owner, and usually you can get your first month of Fusion for only $10. But I do have to remind everyone that those thoughts and today's material are just my thoughts on your questions designed for educational purposes, increasing investing performance and options knowledge. Any stocks or options discussed today should not be taken as direct trading suggestions. More concept of strategy, locking in the gains on the long stock. I didn't tell Srikanth which put to buy. I kind of guided him towards which month I might select, but I didn't tell him which put I would buy. We showed him how to use the tools to do what it sounds like he wants to do, to keep holding the stock, lock in what remaining unrealized profit he has without facing the tax consequences, but still is able to generate premium against it, and that's following the radioactive trading techniques, but bulletproofing from the beginning because he has such a huge unrealized gain. And options do involve risk. They may not be suitable for all investors. Now, you saw a lot on the tools today. You saw the power of the search tool. You saw the power of maybe using the back testing tools to test some things, which gives me some homework for next week. Not this weekend, of course, but next week. We saw how some of those special tools, the signature tools, can help you lock in profits in your positions. There's also tools to help you get back to break even. Well, at any time, you can take a 14-day free trial. If you haven't done so recently, just go to powerop.com, put in your name and email address, no credit card required. You'll have full access to the tools for 14 days, including that 2 to 3 months of the historical tools that we use today to test our 2 search ideas. At any time, you can also check out our other free information, of course. You can go to blog.poweropt.com. As mentioned, you can check out our webinars page. We showed where the 8 ways to manage the bull put credit spread were. That's at poweropt.com/webinars.asp. And, of course, on YouTube. You can always follow us at Power Options, or on Facebook even. You can look for Power Options on Facebook. We're there as well. But a lot of our videos are available on YouTube in a public domain, especially our Friday sessions, and many others as well. But of course, if you do have any other questions anytime, remember, send me an email to support@poweropt.com or support@radioactivetrading.com. Remember, you can also call the office during market hours at 302-992-7971. Of course, trial members and subscribers, remember, schedule those coaching sessions at any time, 35 to 45-minute phone conversation with myself. And it's not just one and done. As a trial member, you can have as many coaching sessions as you want during your 14 days, and a subscriber, you can schedule them at any time as well. Give us a call, send us an email. Have a fantastic weekend. I hope to hear from you soon. I hope to see you all next Friday as well. Take care, everyone. We'll see you soon. Good night.